Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different topic from the world of investment and consider how we can apply the tools of the craft as laid down by its founding father, Benjamin Graham, to the matter at hand. In this episode, we should be considering what constitutes a healthy dividend policy for the investor. We should be looking at the habit that many businesses seem to have picked up of retaining earnings rather than paying them out as dividends. We will be considering the circumstances where this makes sense from the viewpoint of the shareholder, as well as instances where this can prove to be to their detriment. From this, we'll try to arrive at a conclusion as to what shareholders should demand from the management teams in relation to a business's dividend policy. So without further ado, let's get right down to it. As ever, kick back, strap in, and get ready for another lesson in value investment, as inspired by the man himself, Benjamin Graham. In my view, dividend policy, that is, how much of the profits a business pays out to its shareholders each year, should be an emotive one for the owners of any business. The fact that the investment community as a whole seems to barely muster a shrug when it comes to what profits should be paid out to its shareholders and what should be retained by the business is perhaps a sign of the times. Investors generally seem far too happy to place their trust in the management team of a business to do the right thing by them when it comes to maximising potential returns for them. But of course the issue is that the motivation of those charged with managing a business and the ultimate owners of the business, the shareholders in other words, are far from being aligned. Shareholders of course ultimately want to extract the best possible results from their investment portfolio as a whole, whereas the management team are solely focused on doing what is best for their individual business. Some investors might leap up at this point to point out that in doing the right thing for the business, the management team must de facto be doing the right thing also for the shareholders of that business. But things are not that clear cut. It is obviously true that by retaining earnings in a business rather than paying them out, that these retained earnings can then be used to improve a balance sheet by paying down debt, say, used to buy back their own shares, or employed to invest and expand the business. All these things, of course, will strengthen and add value to a business. The exact sort of thing you'd expect your management team to be wanting to achieve. But this does not always automatically translate into being in the best interests of the shareholder. For we have an obvious opportunity cost here. If the earnings are instead paid out as dividends, then the shareholder is free to allocate this money as they so wish, and they may be able to find more promising ways to employ this capital and extract greater value from this money than if the money was instead retained by the business. The fact that the shareholder may be able to employ that capital to better use elsewhere. The business, by retaining the earnings, are denying their shareholders' right to choose. In general terms, what is good for the business may very well be good for the shareholder, unless of course that benefit comes at the expense of that shareholder. There is naturally much to be said of a business retaining earnings under the right circumstances. There are clear tax benefits to be had for one thing. Dividend payments will likely be subject to personal taxation, and through a business's retention of these earnings, the investor will at least postpone tax losses related to this to a later date. There are also plenty of examples where retaining earnings is the obvious and correct thing to do. Businesses that are operating in growth sectors can oftentimes put this capital to excellent use, perhaps even better use than could the investor by allocating that capital themselves elsewhere. Amazon, for instance, have never paid out a dividend, choosing instead to retain the profits to reinvest in the business, and few would argue that this was not the correct thing for the management team to do. Amazon has been on such a dizzying growth trajectory that if you believe in them enough to invest in the first place, then you must surely trust that you are probably not going to be able to put that capital to better use elsewhere. But unfortunately, the vast majority of businesses that do choose to retain earnings are not operating in industries or sectors where the promise of future growth warrants the retention of earnings. And the fact is, most shareholders would be better served if these earnings were instead paid out in the form of a dividend. I believe that even with the potential tax liabilities that may arise through the payment of dividends, in most cases, the investor will be better off receiving their due in dollars and cents. When a business chooses to retain earnings in order to buy back their own shares, then this boils my blood further still. For what are they actually doing other than denying a choice and a right that is already open to their owners, if they were instead to pay out the capital as dividends? A business presumably would only repurchase stock in itself if it was to believe that it was undervalued. A dubious contention, but that is the theory at least. But if the business instead paid out dividends, then if the shareholder believed that to be true, then they are already quite free to reinvest their dividends back into the business by purchasing further stock themselves. Or alternatively, they could invest it elsewhere if they believed that this is where the better value lays. Whilst I would hope in most instances, by retaining earnings, the management are only doing what they are tasked to do, improve and strengthen the business, even if this isn't always in the best interests of their shareholders. There must also surely be times when they are inadvertently being incentivised to formulate dividend policy in a way that best suits them personally. If a CEO has a highly lucrative long-term bonus plan that is tied to earnings growth or stock price performance, then it is clear that every penny they can retain in the business will help them achieve this payout. Every stock that is bought back will help boost that share price, and every cent they invest would be expected to increase earnings. Whether this is in the best interests of the actual owners of the business is by the by. Every penny paid out to shareholders will make it that little bit harder to hit those targets. So given the solid arguments against retention, why are investors in general so supine when it comes to their blind acceptance of retention of earnings? I guess it's the same old story that keeps cropping up, and that is because most know not what they do. It can feel almost instinctive that the CEO that presides over the company is some benevolent, paternal, or I'm glad to say increasingly maternal figure who has their best interests at heart. It is in the management team's interest that the business does well, and if the business does well, then that must surely be good for the owner. Unless, of course, it is not. And we've already considered plenty of reasons why retention of earnings can be a pernicious use of the profit that rightfully belong to the owners of a business. The fact is that most investors do not think in value terms. They do not consider the opportunity cost that is lost through not having the chance to employ that capital elsewhere. This, of course, cannot be said to be true of the value investor. Through receiving dividends in dollars and cents, we can either choose to reinvest them into the business that has paid them out, or else take those earnings and allocate them elsewhere. An opportunity that is lost to us through a business's decision to retain those earnings. So what can be done to persuade management teams to consider the bigger picture when it comes to dividend policy? The owners of a business, the shareholders, must be sure bonus plans are in place that do not blindly incentivise earnings or stock price growth at the expense of the shareholder. Easier said than done, I know, but all too often bonus schemes encourage decisions that can prove to be to their detriment. Government should also look to increase the taxes on share buybacks to a level that is at least in line with the tax implications of the distribution through dividend payments, where this is not currently the case. This in one fell swoop would kill the argument that buybacks are a tax-efficient way of returning capital to the shareholder. It would also greatly aid in the efficient allocation of capital. Efficient allocation of capital is the backbone of any thriving economy, and retention of earnings through buybacks can greatly stymie the flow of capital into the places that can best put it to work, to the detriment not just of the shareholder, but the national economy as a whole. And before we go, and to preempt the question, what do I think of Warren Buffett retaining earnings for the last several decades? Berkshire Hathaway has, of course, rather famously, never paid out a penny in dividends. But what we're dealing with Berkshire Hathaway is a somewhat different proposition to your typical business. In essence, Berkshire Hathaway, in my view, can be thought of as an investment vehicle, rather than a business directly selling you products or services. Most people buying into Berkshire have not done so primarily because of the individual businesses held by the conglomerate. They have done so because they believe in Warren Buffett and his team's ability to allocate capital. Through the purchase of Berkshire stock, you're buying into a quasi-investment fund, and you are trusting that they can do a better job of it than you could do yourself. So paying out dividends historically just would not have made sense. But has that era now come to an end? Has Berkshire become too big to be able to efficiently allocate all the capital it has available to it? In my view, it has. The last I heard, it held some $328 billion of cash, or cash equivalents, that are on hand, ready and waiting to be invested. The issue is there are so few businesses that Berkshire can now practically invest in. The vast majority of businesses on the planet are now out of bounds from a practical standpoint. Too small are they to warrant Berkshire's time or attention. Investors in Berkshire are an unusually astute bunch and could quite feasibly do a better job of allocating that spare capital themselves. Although Buffett and Berkshire do have an uncanny ability to keep pulling rabbits out of the hat. On that, I shall draw today's episode to a close. I do hope that you've enjoyed this talk around dividend policy and earnings retention and it's added a little something to your understanding of the matter. If you have enjoyed it, you know what you can do. Hit add to playlist so that you need never miss out on another scintillating edition. And please do spread the word to like-minded investors that you know. The bigger a community we can make this, the better. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.